Four, three, two, one. We are live. What's going on, everybody? Welcome back to Wolf. It's great to see everybody here. Happy Thursday. We're gonna be jumping into the markets here with Mr. Robert. Excited to get into all the things. Unfortunately, Bitcoin is not doing tremendously well right now. We're down another almost like 4% in the last day. Bitcoin's at like 73.4-ish. And so I don't know who started selling Bitcoin, Robert.
Well,
What's going on right now? But give me some of your thoughts on where we're at in the market. Big shout out to Public as always. Sorry. Oh, I was totally sneezing for like the last minute. I thought I was gonna be able to make it. Big shout out to Public for sponsoring the show today. We'll get a little bit more into them later.
Yeah. So I have to regretfully acknowledge that I was part of the selling pressure. Not my entire stack. I still believe in what I've been saying, which is Bitcoin is kind of this right tail.
Guys, we're not gonna clickbait Robert. We're not gonna quote tweet it.
Yeah, please don't. Yeah, please don't do that.
We're not going to. We don't want to bring that kind of hate.
Yeah, please don't do that. But yeah, I did sell at 80.
Walk me through a little bit why.
Just a feeling. I just had a kind of intuition, and a lot of my trades, not my kind of long-term macro view, obviously, but factors in a little bit. I've kind of always been a very intuitive person with a strong kind of sense when it comes to that intuition, sometimes in a really kind of terrifying sort of way. So I've kind of learned to just trust my gut on things. And, you and I and Joseph and, I've been skeptical of MSTR going back to November of whatever that was, when we were doing some of our first streams. I've been skeptical back. I called the top. That day, I remember we were on a Wolf stream, and this was way back in the day, 2 years ago. And we had been gapping up, and this day it was literally the top. I said, and people were buying out of the money calls. They were aping into out of the money calls, and I was like, look, guys, if anything, you should be selling volatility here. Implied volatility was jacked. It was like 650 for a 30-day at the money call. I mean, it was nuts. Call put skew was blowing out. I mean, it was obvious. It was obvious, and sure enough, the people that did that lost 90% of their money by about a month later. I checked. I followed up on a couple of the contracts people were buying, and it's not, it's not like a nice thing when that happens. But I was trying to warn people going back all the way then. Now, look, I've always said, the issue that I had was buying it here, on this like the top of a parabolic move. But I even mentioned, just like I always do nowadays, I mentioned back then too, look, if you've been holding, going back way back here, 2024, 2023, then you have a different risk reward. You have a different setup right now, than someone who is buying here or here. I was very clear that, what I was recommending, I mean, I can't recommend anything, but that my view was, you should not be buying the top of a parabolic move. And this goes for, Micron as well, or any of the, goes for, all the parabolic AI names too.
Yep.
But yeah, I was selling, I said, if anything, you should not be buying volatility. You should be selling volatility. And, it ended up collapsing. At the time, that was mainly a price action, froth, euphoria, sentiment extreme that kind of led me to that. I kind of knew about, the MSTR playbook and how he was doing it, but it was kind of early days. So I hadn't really, but the more time has gone on, the more that has come out, with these different products, right? STRC and STRF and the kind of, I want to be careful with what I say, but kind of concerning things when it comes to what he's saying, promises that, saying that a preferred equity is, a bond and equivalent to a money market fund, and the way that they are paying the dividends for STRC, right, is to sell Bitcoin. And look, they can pay the dividend for a long time. That is true with Bitcoin at 60 or 70. But if Bitcoin falls to 50 or 40 or 30 or 20 or 10, like at 10K Bitcoin, they can only sustain the dividend for 4.5 years, 5 years, something like that. Now, only, right? That's still
good, but yeah,
a traditional, traditional cycle, but it's not. It's not 35 years like it was with Bitcoin at 80. And this dividend has kind of a ratchet effect from my understanding, right? I'm not an expert in this stuff. It's kind of sketched me out enough that I'm just kind of like not super interested. But from my understanding, there's a ratchet effect where the dividend never really goes down, right? It can only go up. So when you're trading below par, they increase the dividend to try to stimulate demand, to bring capital back into STRC to bring it back to par. But again, the problem is a lot of the assumptions when it comes to MSTR, when it comes to the kind of whole complex, is that Bitcoin just goes up forever in perpetuity. Now, they have built in a good cushion. I don't think he's being insanely reckless, and levering up too much, and going to an extreme with the leverage and the risk. I don't think that. I think he's been trying to. I think they have tried to work in a more conservative way of handling it. Their strategy. I think that is true, but at the end of the day, MSTR holders. He has said himself that you should factor in, like, he didn't say this, but he has made comments to the effect of, like, look, if you're an equity holder, there's a potential that you kind of blow up, and you're an equity holder, therefore you're higher in your risk is higher in kind of the cap structure, and your priority when it comes to our strategy or our when it comes to who are we focused on, right? You're going to be lower in that in that structure, and you could lose everything. I mean, he didn't say that, but it was with Nat Burnell.
I think I'll cheer on MSTR from the sidelines and STRC from the sidelines for a bit longer, maybe.
Yeah, it was, I want to say, early 2025, and it struck me. I watched the interview back when I used to watch every Saylor interview, every Bitcoin interview. Yeah. Oh yeah. I used to watch a lot. And he made it very clear in that interview. It was the turning point for me where I was like, whoa, he just kind of flippantly, it was very flippant, and it was very not dismissive, but it was very flippant, right? In terms of his view of the equity holder. And we know that, there is dilution built in kind of to the whole complex. So, personally, I don't want to be diluted at 5% or whatever it is. Last I heard, the kind of run rate of dilution is about 5%. I could be wrong. Again, I'm not an expert when it comes to MSTR or STRC or any of it, because it, again, kind of just sketches me out. But my understanding, about a 5% dilution. Now, the bulls would say, but Bitcoin per share is going up. And again, I don't know if that's true. If that's true, then it's accretive dilution. But the problem is Bitcoin is going down. Right. So a lot of this would theoretically work in a bull market. The problem is, Bitcoin is very clearly not in a bull market. We have been down only. And I want to point out, to this post I made. I saw this video when it came out, but then I saw someone quote tweeting it. This one where one of his AI rap ones, right? I
had to rewatch this a couple times. I was like, wait, what is happening? I was like, is this real?
Yeah, like, James Lavish. I feel bad for him. I know him quite well. Eric Balchunas, right? Like, I don't know if these guys are really okay with him using, but that came out the top. That was the top in Bitcoin. Came out literally this day.
Why, dude? Every time.
Yeah. And so, yeah.
Robert, I've seen you like lurk in a couple of the trading spaces. You come on stage a couple times even, and it's like a running joke. There's like 4 or 5 people in the space that like whenever they tweet, you like know it's a local top, and it's so funny that you also keep track.
Contra Signal. Yeah.
So oh yes, of course.
Yeah. I mean, I was watching.
If they just had a basic level, a basic level understanding of TA, they just do so much better, you know. But they don't.
Yeah.
I guess I don't know.
I mean, I was watching him get more defensive, you know, the Danny Knowles interview, right? I was watching him get more combative, more indignant. And then, you know, he starts putting out these like horribly cringe AI slop. I mean, he's been doing the AI slop for a while, but the videos, like it was just getting to a point where that was really sketching me out. It was again, you know, this is not a bullish indicator. And you know, my view that I've been talking about for the past couple months, I'm quite bearish on economic growth in the US and kind of worldwide. I'm quite bearish on risk assets. Like what, you know, and a couple of people have asked during the live stream that this stream we do, a couple of people have asked, well, why are you still holding Bitcoin? And like, you know, it's something that I always would say, well, yeah, you know, it's a good question. And I'm kind of like, you know, debating, you know, because on the one hand, you know, what Bitcoin represents, in my opinion, is, you know, a lot of people talk about it like it's a call option. I think that that's a good way to think about it. But it's a hedge to the right tail. And the right tail, given the debt, given the leverage, given the fragility of the financial system and markets and everything, you know, I think that there is a potential, a greater than zero probability that one day we wake up and gold is revalued at 10K per ounce.
Wow.
on the books, right? Or 20 or 30, you know. I've done, you know, some research that's found that so you take the value of our gold holdings, what share of foreign held US treasuries, what share of foreign held debt is backed by the market value of gold? Okay. Generally, going back to the late 1800s, that average was, I think, 30 to 50% in there. Well, if you extrapolate that out to the current holdings of gold and the current amount of foreign held debt, that would equate to about a $30,000 per ounce gold price. Then you look at gold backing of currency, right? M2. How much of the M2 out there, how much of the dollars, the broad money, is backed by gold? And again, actually, there was statutory requirement. I think it was Teddy Roosevelt that that kind of mandated this or pushed for this. That I think it was 30 to 35% of M2 had to be backed by gold. Well, if you extrapolate that out, that's a $30,000 per ounce gold price. It's like the difference between the two is like one is 30 and one is 32, and I can never remember which is which. But generally a much higher gold price, right? Like a 10x. And you know, that is just the historical average. You know, with everything that's happening with de-dollarization, we're living in a world right now where oil is still quite elevated. Dated Brent is still above 100. Real actual oil still above 100, and this is pressuring already. You know, a lot of Asia, they're all pretty much net importers. A lot of Europe, all pretty much net importers. We know that they've been selling, you know, quite a bit. I think I might be able to pull up the one of the video slides that I did on this, but we know that they have been selling. And so, you know, like there is definitely a decrease of liquidity when it comes to demand or potential demand for where is this thing? For U.S. Treasuries, right? Not just U.S. Treasuries, but kind of global DM debt. And I think this one is it. Let's see. I thought I had it, but even the oil producers are selling or decreasing U.S. Treasury holdings. Even the people that are benefiting, right? Because if UK's current account deficit is worsening, right? The deficit is widening. Then that means someone out there, likely an oil producer, their deficit or their current account is getting pushed more into surplus. They all kind of generally balance out at the end of the day. Generally, there's like slight differences, but generally, right? So not only are the people, the net importers that are having their current account pressured into deficit, not only are they selling, but the ones that are benefiting are selling, right? Like Norway, Brazil, can't remember the other one. Canada. Canada is a huge oil producer. Brazil, huge oil producer. Russia, very large oil producer. Norway, right? All of them. Now, Russia and Brazil, they're definitely not going to be buying our debt, right? Because they're BRICS. We sanctioned them. We defaulted on the debt, right? All that. So they're definitely not buying any. If anything, they're selling. And then you have, Norway, Canada. The petrodollar recycling is much lower when it comes to developed markets, like Canada, for example. There's much less petrodollar recycling. For every dollar of oil revenue, right, there's much less kind of recycling into U.S. Treasuries, especially given the way Trump has been when it comes to Canada. So, I think that there is a potential for a hiccup in the bond market. I did a post the other day about the basis trade. There's been some kind of interesting things going on in the repo market that I can show here. So that basis trade risk, which is kind of always there. There are risks, right, where I could see a world where they have to revalue gold. And what that effectively does practically is it deposits that money into the TGA. And so, effectively you'd wake up the next day, they've revalued gold, and the TGA is 3 trillion, 4 trillion, 5 trillion, not 1 trillion. And with that money, they can then buy back, effectively do kind of QE through the Treasury Department. That is effectively what could happen. Well, that would help contain a move in rates, right? If we got a Liz Truss moment and rates just went vertical, that would definitely help the kind of dislocation when it comes to the rate. But, that would be immensely dollar negative if we were to revalue gold to 10, 20, 30K. I think it would be pretty dollar negative even if we revalued at market value. I think that, even that has the potential. So in that world, like, you don't want to not be holding scarce, gold, Bitcoin, whatever it is.
Do you think Bitcoin would move up in that scenario?
I think it would moon. I think we could get a $40,000 candle. Wow. Yeah, for sure. Maybe even more. I think gold could, very well have, a 100% daily candle in that kind of world. Wow. Especially if we were going to be effectively guaranteeing revaluing gold, right? It's one thing to revalue gold, because the way that a revaluation works, again, practically, kind of functionally, is, people are like, well, how do we just set the price at 15K, 20K? And the answer is, the Treasury or the Fed, bank reserves, they'll print as much money as required. They'll buy all the gold. If gold ever dips, say it's 20K, gold ever goes to 19,999, they'll print money, push it up, right? So it would be immensely dollar negative, and gold and Bitcoin would rip. And so you don't want to not own, Bitcoin, gold, some kind of scarce asset. And, as I've pointed out as well, Bitcoin offers the ability to kind of store, transport, and transact, right, permissionless, which I think, given the kind of climate, given everything going on, I think that is valuable as well. So like, I don't want to not hold any, but given my view on the U.S. economy, kind of where it's headed likely the next 12 to 18 months, like, you can't really be bullish bonds as I am, and bullish Bitcoin, right? Like, there is a world where we get a huge move in Bitcoin to the upside, and there's a recession and bonds are out. Like, theoretically, I could lay out a picture where that is true. But the vast majority of market participants, they look at Bitcoin and they just see a high beta, speculative ticker, right? They don't see money. They don't look at it as money, like a lot of Bitcoiners do. So they look at it as, this is a speculative asset. And
I mean, you saw Mark Cuban say that. He said Bitcoin's lost the plot of Sold by Bitcoin.
Yeah,
I think it's like, huh?
I don't. That's not my belief. I just trimmed.
I can see his frustration, but
yeah, I mean, look, like the whole DAT thing kind of turned me off. I got to be honest. Like, strategy, STRC, huh?
Like, totally, is Sailor turn you off entirely, or do you think...
Not just Sailor, right? Like, all of it, Naka and 21 and all this. Like, I got to admit that it just kind of, like, I don't know, I just didn't really feel great about it. And so given my view on economic growth over the next 12 to 18 months, Bitcoin is, if we go into a recession, Bitcoin is going to go down. It's going to go down a lot. If the Qs are down by 40% or more, we think Bitcoin's going to be at 50K, 60K? No, of course not. So, so
I see.
It's just, and the chart, in my opinion, was starting to look kind of not great with this candle here. So and look, I basically, have a trailing limit order, like a limit buy, right? Where if it goes back to 80, I'll buy back in. But I think it's probably not. I think the first move is probably lower. Look, whether or not Saylor selling all of this Bitcoin that he is, it's not even that much. Like,
32 Bitcoin.
I think it's more the.
I think you're pure overblowing it a little bit.
Well, I think it's what it indicates, to the uninitiated kind of casual Bitcoin person, right? I think it's more what it indicates. And
what do you mean?
So, well, I think that, a lot of people have talked, Bitcoin's gonna go to zero if Michael Saylor ever, if he, Michael Saylor gets in trouble. Bitcoin's, I mean, dude, if
Saylor sold a big position, that would be that would be bad. If he sold $1 billion worth of Bitcoin or something,
but he's not, right? Like,
he probably wouldn't. I don't see any reason he would need to.
Yeah, so I mean, I could, like, we get a recession that goes on for 10 years.
You would sell? Do you think you would sell?
We would have to.
Yeah.
Right? If we had a recession, like,
so you would basically be like, game over. He's like, okay, guys, like, the experiment failed.
Look, Bitcoin didn't work. In Japan, they had a 25-year recession, basically.
Dude.
What
do people do in that scenario? What is life like in a 25-year recession?
Well, wage growth was negative, meaning people's wages per year were going down.
It's crazy.
So, deflation, house prices were falling. The Nikkei, it took, we'll pull it up. It took like 30 years for it to get back to the same point that it was at. I think it was like 30 years. So back here was the bubble in 1990. And it took 12,000, what was that? 2024. So 34 years, right? If you had bought the stock market here in any of this period of time, the year leading up to the bubble bursting, it took 34 years for you to get back green. So, like people act like this kind of thing is impossible. It's happened to other developed countries. And of course, we know kind of what happened with the Bank of Japan, right? They took interest rates negative, yield curve control, kind of all that kind of thing to try to get out of it, but they weren't able to. It's not to say that we wouldn't be able to, right? I think that that would, with the amount of leverage, the amount of debt, a 10-year 15, 20-year recession like Japan, rolling recession, like that would not be tolerated here. And they would print a lot of money. They'd print more than Japan. They would be more aggressive than Japan. So in that world, like Bitcoin's not going to be doing well in a world of deflation, right? Where wages are falling, financial assets, houses, stocks, really the only thing that's going to rally is bonds. Financial assets are falling in a world of deflation. Again, we haven't really seen a world of deflation except going all the way back to 2008. We had deflation back in 2008, a brief moment, but our leverage was much lower. Debt to GDP was 60%, I think it was, back in 2000, that period of time, early kind of mid 2000s. We could not afford a period of deflation now. So it's, but that being said, Bitcoin came after 08, right? Bitcoin came in 09, 2010. Like by then, we were relatively we're definitely out of deflation, and we were coming out of kind of the financial asset, the bear market and that kind of thing. So we don't know how Bitcoin, like people have never seen Bitcoin through a recession, through a period of prolonged deflation. People have never seen it. And I think that, it could be quite ugly. And in that kind of world, he's going to have to sell a lot of his Bitcoin. And so, yeah, I just, hopefully I'll be able to buy back. I plan on buying more for the same amount of money. And look, if it starts to rip, I still have a good share of I still have a decent size position, but I was trying to weigh, okay, so Bitcoin is this hedge for the right tail risk. What is the likelihood of that right tail risk in relation to the risk reward? How much could I lose over the next 12 months or whatever in Bitcoin? How much could I gain? What probability do I ascribe to the gain, to the loss, right? And then what probability do I ascribe to what is the probability of that right tail? And I've kind of been just kind of thinking about all that, trying to kind of find where I land, and I landed with, it's probably a good time to trim here. And it's not that big. It's not that I'm leaving, and gonna sell all of it and I'm done with it and I hate it, and it's nothing like that. I just think, given the kind of macro environment, liquidity is pretty good. You got M2 really started to kind of reaccelerate. You had the reserve management purchases from the Fed. There were reasons to be bullish from a liquidity standpoint, but we look at the price actions, it's not showing that it was very bullish. Maybe this is 4-year cycle stuff. I generally don't really put much weight in the 4-year cycle. I think that things like what the Fed's doing, what GDP growth is, not just here in America, but worldwide. What is the S&P 500 and kind of equity complex doing? Like, all those kind of things matter way more than the 4-year cycle. We are not back in the mid 2010s, right, where Bitcoin was nascent and the kind of supply demand, the halving, all like, right, that mattered back here, back during this period. But nowadays it's so institutionalized, it's so much larger, right? There's all these structured products, short volatility products, all this kind of thing, that like, I think that, but that being said, there's still some amount of 4-year cycle playing out, so you gotta kind of respect that. where it bottoms, I don't know, but I'm going to be patient, and hopefully be able to get more Bitcoin for the same amount of dollars that I had.
You very well might.
Might have been 79. I don't know. It's one of those. 79, 80. But yeah, and look, we got I think another thing that is harming Bitcoin, or not. Maybe it's not harming Bitcoin, but it's not benefiting Bitcoin. Over the past 6 months, the SMH, which is the semiconductor ETF, one of them, is up 71% just in the past 6 months. It is almost doubled in just 2 quarters. I think the SOX, which is weighted a bit different. I forget. They have different weightings, but the SOX I think is up more. Yeah, 93% over the past 6 months. So we have this kind of AI bubble thing going on, and I think that is kind of the shiny new thing for people, and I don't think it's helping Bitcoin. Maybe it's not actively hurting Bitcoin, but I think a lot of people are chasing the things that are moving. You got Micron doing crazy parabola kind of moves. You got SMH, SOX, all the kind of semi stuff, but you also have like Intel, right? Intel is just absolutely ripped. This is the one the US government took a stake in. So yeah, I mean, we're seeing these kind of moves.
It's kind of crazy to know that the government's a shareholder.
Yeah, it's definitely a different world. Marvell, I mean, this is where the momentum chasing 267%, right? Wow. You look at South Korea or Taiwan, TSMC, right? Like the stock market cap to GDP for Taiwan is 540%. South Korea, 235%, right there with the US.
Jeez.
This is the bubble. This is where the momentum is. People want to make money. They don't want to see. I'm generally not, I think, like a typical trader, which is I like to find something beaten up, left for dead, sentiment at all-time bearish position, that kind of thing, right? And buy that. And I don't think Bitcoin's there
right now, or is there nothing else?
TLT bonds. The long end of the yield curve is the most hated that's probably ever been. And short interest on TLT is at an all-time high. And I look at this chart and it looks exactly like WTI looked when I was calling it out for my YouTube people back here.
Holy crap.
And the Goldman Sachs commodity index too, right? Like this kind of price action is what entices me. I like to buy something like that, where like WTI, they were calling for the great oil glut of 2026. Sentiment was like max bear, you looked at the price. I saw, really nice, like double bottom. I was from a macro view, I was kind of bullish on a bit of a reacceleration in inflation and growth globally. Kind of thought we'd get a little bit of a pump, and good for the demand side with oil. And look, we ended up getting a war in the Middle East, but the chart, that's usually how it goes with charts, right? Like something looks bullish, and then a couple days later, you get some headline that happens to be really bullish. Like it's just one of those things. I don't know, I'm not a conspiracy, it's not, I don't think it's that, but it's just one of those things that I think is hard to deny. So I look at the SPY and I'm just like, I have no interest in buying this here. I want to buy something or Micron or Marvell or Intel or any of that, SOX, SMH. But that's not how most people are. Most traders are looking for the things that's moving. If Apple or Microsoft or Meta, if these things are moving and they have momentum, they're going to ride the momentum wave. Yeah. I mean, we even have entire kind of like cottage industries devoted to momentum chasing called CTAs. And a lot of what those guys do is just trend following, kind of systematic sort of thing. And, that's kind of another thing. We've had implied correlations. There's equity market dynamics that are quite extreme. We've had implied correlations basically reach an all-time low, which indicates an extreme amount of kind of macro complacency, index level, and kind of overall complacency. We have the other way of putting low implied correlation is very, very high dispersion. And sure enough, dispersion is basically at an all-time high. So, you have those kind of triggers. Realized vol is below implied vol, and realized vol keeps falling. This is one of the reasons that we've kind of had this grind higher in the equity market with the VIX at 15 is due to this kind of dynamic, and the systematic funds that trade off of these kind of triggers, where they're not fundamental investors. They're not buying on. It's just, implied correlations and dispersion and realized vol versus implied vol and skew and like all this kind of thing. And that's pushed the equity market higher. That, we have extreme amount of chase and euphoria in, the put call skew in some of these semiconductor AI names is outrageous. People are buying calls. We had a move in the VIX higher, right, for a while there. I would notice S&P 500 up, VIX up, and people go, well, that makes no sense. Well, what that indicates is, when you have that spot of vol up sort of regime, indicates that people are buying out of the money calls to an extreme degree, right? Because that is pushing the implied vol to. So we've had, the momentum. We've had some pretty extreme kind of technical, mechanical sort of things going on in the equity complex. And, look, when Marvell moves, I forget what it was. I think it was like 34% in a day yesterday.
Wow.
When you have those kind of moves, like it was back here. It was 2 days ago. You had to move a gap up and they closed 33%, right? So when you have that kind of thing going on, Bitcoin is not the shiny new object that's going to make you a lot of money. When you have this kind of thing, when you got this kind of thing going on, when you got Micron, when you got all these different names, Bitcoin is not the high beta sort of number go up thing that it kind of used to be. And I think that's kind of hurting it.
It might be. I think other people are also nervous about that as well, like the narrative around it, and how that's going to continue to develop. I see Nat also gave a comment here. She said lower first before 80K. And then she said TLT will surprise many. PE ratios are also high, she says. So
yeah, I think it's
Nat.
I think it's the CAPE ratio. It's like basically at an all-time high valuation. And look, and the earnings that are priced in are extreme, right? And for example, you take like a DRAM name. What happens when a model comes out that's way more efficient? What's going to happen to the price, or the demand from the NVIDIA, for example? Like, there are all of these risks, to say nothing of the valuation. The valuation is premised on earnings that are like factoring in insane growth rates, insane margins that just continue in perpetuity. That's not how anything works ever. There will be a glut, if anything, of memory, of semiconductors. Now, maybe that glut doesn't appear for 9 months, 12 months, but I'll remind people, the Microns, the NVIDIA, those were cyclical businesses historically, right? And, people are trying to claim a super cycle and that they are no longer subject to kind of cyclical economic factors. But I think that that's a dangerous gamble. This time is different is never generally a good way to approach things. And I think that it's gonna there's going to be a lot of pain. There's an insane amount of leverage in whether it be leveraged ETFs seeing record inflows, whether it be the insane amount of leverage in the options complex with put call skew just blowing out. Their margin debt is quite high. All this kind of thing, like, the concentration for over 40% of the S&P 500 is one sector, which is AI. That is generally, that concentration is always historically every other bubble peak. That is always, a concentration kind of limit. And once you get beyond 40%, now, again, if you think this time is different and AI is going to be 100% of the economy or 80% of the economy, singularity and the fourth industrial revolution and all this, in my opinion, nonsense. If you believe all that, then okay, maybe 40% concentration doesn't matter. I think it still matters. I think that the real productive economy still matters. So I think there are a number of issues. You had, I forget the guy's name. He was just on Bloomberg on their radio show talking about earnings. Huh?
Oh, never mind.
No, I can't remember his name, but he's got a show and a Substack, and but he went on to talk about NVIDIA earnings, to talk about AI earnings, and he was pointing out, Anthropic, OpenAI, like these companies are not profitable, and there's really kind of no path to profitability in the near term. So then you have the kind of circular revenue going on, right, where a lot of this money, quote unquote, these earnings is just being recycled to one another. There's 9 companies and they're all just shifting around. I mean, you've seen the meme, but just plugged outlet extender just plugged into each other. I mean, it's kind of true. You got vendor financing going on. You have extreme amount of delays going on when it comes to data center construction, where like over half of them are delayed by more than 6 months. There are a number of issues that I think are pretty like you total up all of that, the concentration, the valuation, the circular revenue, the vendor financing, the potential, I don't want to say the word, but some people are claiming that there's fraud, accounting fraud with some of these companies. And again, I'm not making that assertion, but there are so many risks right now with that complex, with the very thing that is propping up the S&P 500, that I just, I think it's going to come apart. I don't think that I don't think AI is totally worthless. I don't think that every AI company is going to zero, just like .com, there were winners, there were losers. I think it'll be similar this time around as well. So yeah, I look at that, and then I look at the economic, kind of broader economic growth picture, and it's quite poor in my opinion. I mean, you have, again, physical oils basically double what it was. Data Brent, there's no chart, I always forget that. Data Brent is double, real actual oil is double what it was before the war. You have interest rates that are notably higher. Both of those are going to tighten financial conditions, right? We live in a debt-based system. We overconsume. The only way to do that is by increase of debt. Well, that debt just got more expensive, not just for the government, but for the average American, credit card, auto loan, mortgage rate. Higher interest rates, higher oil, which again, I view as a tax. We just doubled the tax when it comes to energy. Interest rates, which is the cost of debt, that debt being required to sustain our overconsumption, consumer-driven economy. You like add all of that up, and I think that growth is going to not be great. And the one sector that's been holding up GDP, the one sector that has bolstered growth, is this AI sector. This AI thing that we've just been talking about. And so what happens, right? There's about $1 trillion of planned capex for the year 2026. And next year, I think it's going to be like 1.4, 1.5, 2, something. I mean, just insane. It's like doubling every year, the capex, right? Yep. And that is bolstered by my math, looking at the BEA's own data, GDP would basically be zero without AI. The one kind of small AI thing, GDP would basically be zero. So
but wouldn't that money disperse to other areas though?
Maybe. I mean, is there anything else that people are eager to invest in? Right? Because GDP, consumption plus investment plus
Pokemon cards.
Huh?
Pokemon cards.
Yeah. Investment, consumption, net exports, and government. Right? So if consumption is slowing because oil just doubled and people are personal savings rate is near an all-time low, right? We can look at that. Personal savings at an all-time low. Wage growth is horrible. Real personal income is horrible. The average American is screwed, right? So consumption is certainly going to. It's been slowing, and it's going to slow further. That the C in GDP is not doing well. You look at the top 10%, right? The luxury, the wealthy that are. You look at like luxury names, the top 10% are not doing well either. They're pulling back on spending. Look at Ferrari, look at Louis Vuitton or Hermes, right? They're all not doing great. So they're pulling back. So consumption is definitely pretty weak and is going to get weaker in my opinion. Investment, right? All this kind of CapEx and investment in the AI. If that goes away, like where else are people eager to put their money? Now, I could come up with a list that would be smart, that would be productive for the U.S. economy, right? Energy, shipbuilding, right? Like steel, right? Like rare earth mineral. I could come up with a list, but that does not mean that the average investor out there is willing to invest in that kind of thing. They want to invest in AI. It's the shiny thing. People make a lot of crazy, insane claims about it, right? Like that is where people want to invest. So if it's not AI, I think that the bull for GDP on the other side, if I was having a debate, and they brought up, well, if it's not AI, I would say, okay, if it's not AI, then what is it? What are people going to invest to this degree in, right? I don't think the eye could withstand a AI, I don't want to say blow up, but if AI kind of if the capex, if that $1 trillion of capex, if the hyperscalers and the kind of AI, if they start to pull back on their capex intention, this whole thing could come undone very, very quickly. Because remember, all the, if one company that company holds, the AI lab. You look at other income for Google, Meta, right? All these companies, you look at where the income is actually coming from. It's not as much operating. It's the increased valuation of the AI lab equity that they hold. And there are a number of issues there. But if you start to get a pullback on CapEx, that's going to trickle through to every other part of the AI complex, right? That's true. And so it all comes. So that CapEx, that $1 trillion getting pumped into GDP, right, goes away. And then we're in a recession. And that's in addition to consumption, the C, falling. Now, you could get the government, G, to come in and, we could double the deficit, right? We could take the deficit from 1.7 trillion per year to 2.4, 3.4, 5, like that is possible. I don't think that's very likely. I think that the deficit will blow out, but I think it'll be due to a recession. I don't think that they're going to proactively increase the deficit to the degree that would be needed. I don't think they're going to do it proactively. I think it's going to be in response to a recession. And then net exports, right? You look at our trade deficit, which is net exports. Look, it's improved a little bit, right? 60 billion a month. Go back to January of 2025. Well, it was already blowing out due to Trump. I guess you would have to go back to like November 2024, October, November. It was 73 billion in October, November 78. So maybe net exports have improved a little bit, but you have to continue to improve, and I don't see that with the dollar as overvalued as it is. I don't think net exports is going to be a huge boost to GDP. So I just went through the way GDP is actually calculated, consumption, investment, net exports, and government. We covered all of them. Like, I don't see the bull case. And so I think, bonds are going to do well. And most of these, kind of risk assets, whether it be the tech stocks, the S&P 500, which is basically the tech index, right? People think they're diversified. Oh, I buy an index fund. I buy the S&P 500. I'm diversified. You're not diversified. You might as well be buying the Mag 7, the mags. So yeah, or the Qs, So yeah, I just, all of that, kind of the next 12 to 18 months, I look at that and I'm just like, Bitcoin's not going to do well. Well, like, what benefit is there of me holding it when I could, like, it just, to me, if I have the conviction that I do in that view, when it comes to growth, when it comes to the way that kind of, broader risk is going to do, if I have that view, and it's pretty strong, I mean, my TLT call position is quite large. It's 15%. I'm really like going first. I'm really swinging for the fence here.
You would cook if this one plays. You've explained the trade on this one before.
Yeah, it would do very, very well. And I have very high conviction in now. Maybe it's not by January, right? The January call is much lower size. It's only like 1%. That is kind of a look. If I'm right and we get a huge rally in bonds like they do, like the long end can do. If we get that, then my January calls are going to be worth like a gazillion dollars. Those are going to, 20, 30, 40x. But, kind of my core position being June 2027, 95 strikes. So less out of the money. That's the majority of my position. Then I have TLT shares, and like you add all that up, I think it's like 22%, something like that. It's quite, so I have high conviction in very bullish bonds for the next kind of 12 to maybe 24 months, right? Like that kind of time period. So why would I hold a high beta risk asset that I view as money? I wish it was money, right?
Yeah.
All of that, I wish it was. I wish the rest of
so you're rotating the money from that position into this
cash,
for this
into
trade,
cash,
or just
into
holding
cash,
cash? Okay,
into just cash. I have pretty high. Look, cash is getting 3.5. The TLT is getting 5. That offsets whatever theta cost, right? Because holding the options, theta is not huge because they're leaps, but there is theta, a time value that is costing me, and the 5%, the 3% on cash, is helping to basically reduce that. And I'm just kind of waiting, and I'm okay with like waiting. I don't get this urge for people to like always be super long on something. Like, I'm just trying to be patient. Same thing with SpaceX. Like, look, I really think I'm very bullish on space long term, 20, 30, 40 years. But like the valuation, the issues with AI, I mean, I was looking through the S1 and XAI is, so I would recommend people look at the S1. Like, do I want to own SpaceX? Yes. But am I going to chase it on IPO day? Probably not. I've kind of made up my mind. Like, I am bullish. I just don't want to, like, you look at that, you look at what the S&P 500 has been doing.
Valued at 1.75 trillion, right?
Yeah. And like, that is the kind of thing that you see at a top, like the narrative kind of writes itself. Anthropic, OpenAI, SpaceX, all IPOing. I don't know. I'm not calling a top today in the S&P 500. I do think it's notable. Yesterday, we got a pretty brutal, sharp pullback, kind of out of nowhere, kind of for no reason. I think that when there's not a reason and you get a sharp move, I think it's worth paying attention to. That's not to say that was the top here, but yeah, I look at the SPY or the Qs or SMH or any of that kind of stuff. And I'm like, okay, what's the risk reward? If I'm getting paid 5% to be in TLT, does SPY would have to go up 5% or more? That would take us to about 800 on SPY, right? Like, what am I versus the downside risk, right, of CapEx starting to decline, and consumption is very weak right now, and government deficit is not growing like it was in 2023, 2024. The G is so, like, you look at all that, and the downside risk, in my opinion, to the SPY, I mean, you're talking a 30-40% decline if we go into a recession versus a 5%. I mean, you know what I mean? Like, the risk reward of, okay, so I would have to make more than 5% on the SPY for it to be worth it. And that would be here. The downside in a recession, let's be generous and say 35%. That is the risk reward right now of going along the S&P 500 with each kind of new marginal dollar. That's the risk reward. I think that's horrible. You know what I mean? So, people want to chase, people want to ride momentum, people want to be bullish. I get that. And they can, if that's your style, then go for it. I will be going long on SPY when sentiment is max bearish. Everyone has given up on AI and tech, and it was all a bust, and we're much lower, and that is when I would like to buy. SPY, Qs.
It's a good thing to have cash.
SMH.
Dude. Yeah, Ryan Lau was just talking about that. He said he has his biggest cash position right now.
Yeah, I'm like 50 something, maybe even 60% cash.
Wow.
And that's fine with me. Like, I don't care, it's earning 3.5. My TLT is getting 5. I just don't care. I'll trade, like, I'll do my, I'm long oil. I got long on oil here. Back here last week. So I got long on oil there. Nice. So far looking pretty good.
Yeah. Wow.
Yeah. Like, I'll still generate returns through that kind of thing, but just the kind of buy and hold portion, like, I really have no interest in buying SPY here, or Qs, or SMH, or I think cash is, you look at Michael Howell's liquidity cycle, which kind of lines up with the business cycle, which is really a debt refinance cycle, and ISM cycle. You look at that, and like where we are now, that cash is becoming where you want to be. Commodities were, that might have another month or two or a couple months in it, but like cash is next in that cycle. Indicated in terms of what you want. Then it's bonds. I'm happy though I don't think that there's very much downside. Again, the risk reward on TLT is the exact inverse, the exact opposite of that 9-to-1 risk reward that we were looking at with the SPY. It's the exact opposite with TLT.
Yeah.
You think the government, the Treasury Department, Scott Bessent is going to allow the 20-30 year Treasury to go to 8%? You're crazy. There's not a world where, now look, you shouldn't, I could not be more bearish on buying an actual 30-year bond. I am buying this to trade it, to sell it at a higher price. When bonds rally, rates fall, I am not buying a 30-year Treasury. I could not be more bearish on doing that. And I try to always point that out because it's a really important distinction. Look, they are going to have to financially repress the bondholders. I think that it'll be more focused on T-bills, and the short end, and you look at stable coins and what they're trying to do there. I think it's going to be more there, but they're going to have to financially repress bondholders. So you don't want to buy a 30-year Treasury at 5 because over the next 30 years, you will have to have a negative real return. Otherwise, the debt burden is just going to get worse and worse and more untenable. So they have to force you to take a negative real return in real terms. But like, say the negative real rate is 10%, like it was, we can look at, I think it's SPX might work. We can look at the real rate back after World War II. It peaked at, I think, -18. So back here in the 1920 was quite low too. About -18%, meaning that if you bought a 10-year treasury, that the yield on that 10-year treasury was 18% lower than inflation, right? So 1% yield, 19% inflation, or 2%, 20% inflation. I think, do we get to that extreme of negative real rates of like 10, 15, 20%? Maybe. We could do that for like 2 years, right? Negative real rate of 20%. We could run that playbook for 2 years and basically get out of the debt issue. Now,
That's
the
crazy.
dollar is going to weaken and gold is going to go up and Bitcoin's going, there are consequences, right? Inflation being one, CPI inflation, but also gold, Bitcoin, home price inflation. But, they could do that for 2 years. They could do negative real rate average, right, of 2%. If you buy the average bond, weighted average maturity, if you buy the average bond, you're going to lose 2% per year, and that'll be the negative real rate. We could run that for 10 years, and get back to a much better position. It could go a number of different ways. I don't know if Israel ran, I think their
high interest, right?
IR is Iran. They ran inflation. It's IL. They ran inflation really hot. I think that at the peak, it was like 110%.
Wow. The heck?
Yeah, it was quite, but they got, you could do that.
Wow.
This was back in 85. Inflation peaked at 480%. But you could run inflation at, 100% or 80% for 1 year and get out of the debt issue. Now, there's, again, consequences, but you can do, different, there are different ways of doing it, and yeah. I don't know which way they're going to pick, but there has to be negative real rates. Or the debt issue is going to get worse and worse and worse and worse and worse. So, again, buying an actual 10-year note, 30-year bond, I could not be more bearish on doing that. But I think as a trade, everyone is worried about inflation, and no one seems to understand or remember what happens going into every single recession, which is oil price does what it's doing, spikes. And the balance sheet capacity, the average American spending power, we see personal savings basically at an all-time low. I mean, very near to an all-time low. If you look M2 adjusted, per capita M2 adjusted, it is basically at an all-time low. So the purchasing power of the savings, right, near an all-time low. You have wage growth running below inflation for 8 of the last 9 months. You look at the labor market, it is so tight. You don't have the 2022 dynamic where, I could just quit my job. The quits rate was through the roof. I could just quit my job. It's not through the roof anymore. Quits rate is quite depressed. I could just quit my job, go find a job somewhere else, get paid way more money. Like those sort of things that allowed the average American to absorb the 2022 shock in oil price. Those sort of labor market dynamics, liquidity dynamics, right? Both from the Fed and on the M2, the broad money side, all of those dynamics are the opposite basically now, right? So what allowed us to, we still got 2 quarters of negative GDP here, right? After the oil price shock of 2022, we still got a technical recession, 2 consecutive quarters of negative GDP, a bear market in S&P, right? S&P and Qs fell more than 20%. we got all the indications of a recession. It's just that for political thing, So yeah, so but again, the reason the recession, if that oil price shock, if oil goes to 120 again, I mean it already has, but it's a much different story. That the average American back here, personal savings rate was through the roof. I mean, I'll put it on here. It's through the roof. And so they were able to absorb. Look at the personal savings rate here. It peaked during 2020 at 32%. But here in kind of mid 2021, it was at 26%. Now it got drawn down. You can see it's inverse to oil, right? As oil moved higher, personal savings rate moved lower. I'm sure it's probably very tight correlation there.
Wow, look at that.
And oil's moving higher again, and so personal savings rate that's inverted now, 2.6%. I mean, you have to go back to right before 2008. People try to make the personal the savings rate being low. They try to make that a bullish indication. It's like for the last leg, for the late cycle pump, which we are seeing with ISM. Yeah, sure, it's bullish for like a month or two. Like you do get that kind of last impulse higher, with growth, but it's not sustainable. And then, what happens next, I think, is what you want to be positioned for. And what happens next is people have no more savings. Their personal income, their real purchasing power is going down. So they're basically getting their wages cut. It's kind of, I think, an easier, more intuitive way to think about it. They're getting their wages cut, and they have less spending power. The C, which is 68% of U.S. GDP. We know the top 10%, they're not doing super well. If you look at the luxury names, Ferrari, Louis Vuitton, Hermes, right? All of those, they're not necessarily spending a lot. They're not super confident. They got geopolitical uncertainty and, there's some kind of low. So they're not holding everything up as much. And if the equity market starts to have a hiccup, that top 10% is really not going to hold everything up. The bottom 90%, the bottom 90% spending their money is a third of American GDP. A third, 30%. People talk about oil being a boost to GDP. Oil and oil production is 1 to 1.5% of GDP, right? The bottom 90% spending their money, just the bottom 90 of GDP. That was 33, 34%. Actually, yeah, 33%. So yeah, I think, you have higher interest rates, you have the higher oil tax, right, where real oil has doubled. And that's, both of those are going to be a hit to growth in a debt-based overconsumption, consumer-driven economy that by definition overconsumes. And then God forbid CapEx, right? If investment starts to fall, and CapEx intentions start to, if that whole kind of AI bubble dream thing, right? Like if that all starts to unravel, the eye goes away, that CapEx, that $1 trillion of CapEx might go to 100 billion, 200 billion. Then what? Then you're talking a recession.
Yep.
And if you combine it with lower consumption, you're definitely talking about a recession. So I think that people are focused, for the next couple months. Look, the Fed's probably not going to cut or hike, in my opinion. They'll probably hold rates. We do have higher inflation. We got PPI running at 6. We got, CPI running at basically 4. Could go higher, I think for the next couple months, that is probably but inflation always does that going into a recession. So here's producer prices. I'll take off personal savings rate, which we already covered. Here's producer price index inflation minus consumer price inflation. So we're looking at spread between producer inflation, and then what gets passed on, how much inflation actually makes it to the consumer. And look at what it does going into every recession. PPI relative to CPI blows out. And the firm, the corporation, is left with a choice, which is, if it, right now, 2.2. Right now, producer inflation is 2.2% higher than consumer price inflation, meaning that one of two things must occur. Either the producer, the firm, the company, the corporation must pass that increased cost along to the consumer, where you will likely get demand destruction because, as we covered, the average American has no ability to afford that kind of significant inflation, significant price increase. They will just stop spending money. You look at default rates, for example. Default rates are 90-day delinquent. The Fed just came out. Delinquency rates are moving higher. People will just stop paying the credit card bill. People will just stop going on vacation. People will just stop going to Target to buy the random thing you don't really need.
Yeah.
That'll be what happens in option one. Option two is the corporation goes, well, we know the average American can't really tolerate a price increase, try and pass through. So we'll eat it. We'll just eat the difference. Our inflation is 5 and their inflation will be 2. And the difference, the majority of it, is going to be an erosion of profit margins. So either of those two things is very bearish, right? Because either they try to pass it along and you get demand destruction, where the C, which is 2/3 of GDP, goes significantly lower, which consumption, if you look at the GDP report, consumption is already going lower over the past couple quarters. They try to pass along costs, it'll go even lower. It'll be a negative drag probably to GDP. Right now it's a tiny boost. I think it's like 20, 30, 40 bips percent contribution. That'll go to 0 or negative if they try to pass it through. They get demand destruction. And then you also got an erosion of profit margins. Well, that's not bullish. Because earnings will decline, profit margins decline, right? And that has a trickle through effect. As Luke Gromen always points out, with regard to the AI and the job market kind of thing, you don't need AI to take 20% of jobs. You just need it to take 5. And then the leverage inherent in our financial system will do the rest. And he's right, in a highly levered debt-based monetary system where we overconsume, meaning the only thing we can increase is debt, and we need to increase debt because we live in a debt-based monetary system, and that debt base must always expand. There's quite a bit of leverage right now, and it's not in the housing market like it was going into 2008, right? There was obviously a leverage issue and a risk with debt with the housing market going into 2008. We don't have it in the housing market anymore, right? It's in other areas. Could be private equity, private credit. I mean, combined, that's $5.5 trillion. It's not huge, mortgage market, $12 trillion, but it's big enough, then you add the AI thing, maybe it's AI, you add all that together, they're, the market cap. So I don't know, where exactly the kind of leverage, the cascading leverage issue, is going to show itself. I'm not like shorting the banks or, trying to trade that. But you don't need huge, you don't need, 20, 30% of people to lose their job. You just need 5%, right? And they stop paying their mortgage. They stop paying their car loan. Who owns the mortgage? Well, it's not the bank that wrote the mortgage. The bank that wrote the mortgage has packaged up the mortgage into a mortgage-backed security, securitized it. That mortgage-backed security is used as collateral in the repo market, for example, right? So people need to think, 2, 3, 4, 5, 6 steps ahead, out in the chain of how these things kind of actually work and not just the first order effect. And once you start really kind of thinking out, it's clear that we're in our economic system, our financial system is quite fragile, is I think what I started with. And, I don't think it's going to take much. Again, the C, I think, is the one to really focus on. that consumption is really, I think, the one where we should focus. Bottom 90% are not doing well. Personal savings rate near an all-time low. Consumer sentiment at an all-time low. And yeah, you already look at the GDP report, the consumption component of GDP, the percent contribution to the overall figure has been declining for the past 3 or 4 quarters. It is no longer a boost. Back in like 2023, 2024, consumption was a 2% boost to GDP. It is now, again, like 20, 30 bips, hardly anything. So I think that's where it's going to probably come. But, so maybe like consumer discretionary, short, something like that. But yeah, all that to say, I just don't necessarily see the bull case. And in that world, what do you want to own?
Yeah.
Cash is a position. There, in my opinion, are more risks to the downside than there are to the upside. So trimming Bitcoin, if I was long equities, I'd be trimming those, or selling covered calls, or run a collar up here, or something. But people are free to be bullish. People are free to drink the Kool-Aid and, fourth industrial revolution. I mean, turn on CNBC and Dan Ives is doing it every day.
I was going to say, it's tough because, it's like sometimes it feels like it's over. And then, a couple months later, you're like, I guess we're still trudging along. I don't know what's next.
Yeah, look, it's the thing about macroeconomics. It does not, you don't just wake up one day and everything is blown up. There's a long and variable lag, as the Fed always says, when it comes to transmission of monetary policy. Macroeconomics, especially kind of the bigger macroeconomic forces, right? These are things that take months, quarters, years to play out. We're still arguably dealing with some of the inflationary impacts from 2021, 5 years later, so yeah.
1 second. Let me, I just got a message from
people that think that, next GDP print is going to be negative 2%, and the S&P 500 is going to start plummeting every day by 2%. Like, that's not how it works. This is why I bought June 2027 calls on DLT. It's going to take a while.
Yeah. I mean, I saw Nat. She was, I think she agrees with you as well. She tracks a lot of these things. I'm going to ask her as well to get her thoughts on your take during the stream too. Because she seems to be she's pretty active in this industry as well, and so there's only a few people I know who are tracking these things correctly. Because you mentioned Dan and a few others are sort of just like around, and they're just generally just macro bullish. Tom Lee's like these guys who, and like a lot of the times they do end up being quote unquote correct because the market just does trudge forward, but.
Yeah, and usually I'm one of them.
So
from 2022, maybe 2023, up through January, I was one of them. So I generally agree, but I that is the bigger trend, right? But that doesn't mean that there aren't cyclical. Right, you're gonna get downturns within the larger kind of debasement theme, the larger, everything goes up and to the right. Like, that is true. That is the mega trend. But again, within there, you are going to get the business cycle. You're going to get credit cycle. Credit spreads are quite tight, I think, for the amount of risk right now. But but generally, Ed Yardeni. Not Dan Ives. I mean, he's kind of crazy, but Ed Yardeni and kind of the more serious macro guys that are kind of perma bulls, like, I'm generally with them, but I'll point out, even Ed Yardeni was put out a note where he was calling for quite a pullback. I think it was like a 10% pullback. I think he might have lowered his year-end target for the S&P 500. So like even Ed Yardeni, right, is getting a little bit more cautious. When you turn on Bloomberg, I watch Bloomberg more than CNBC, and it's just CNBC is even crazier with this in regard to this. But like, people are just like, yeah, it's a bubble, but what are you going to do?
Exactly.
You gotta be part of it, and it's like, what? People, yeah, it's a bubble, like, but you just buy. We talked about this a couple weeks ago. I heard this woman. But you just buy. Buy what?
You just
buy anything. Buy
Doesn't
anything.
matter.
Just buy. Don't matter. Yeah. Like, guys, we are. You look at Wall Street Bets and stuff, and the uninitiated retail guy that just aped into some 2x levered semiconductor ETF and made 500%. He's showing it off to, like, all that kind of stuff. The arrogance that you get with the bulls, not necessarily like the serious investors and traders, but the kind of less educated retail, like the arrogance that you get from them, all that froth. You just look at the put call skew on Micron or Nvidia or SMH or whatever. Like, the indication, you can quantify froth, you can quantify euphoria. And all those measures are very near to all-time high, definitely, cycle high. So.
Yeah. I mean, on some level, a lot of these people are correct, and if they're wrong, they'll just wash their hands. And then once the bleeding ends, they'll be like, okay, time to buy, guys. What do you buy? Everything. And then the whole recycle repeats, and then Roberts goes crazy. That's how these things end. Dude, we gotta bounce here to do a space, but
no worries.
Great stream as always. Like I learn a ton every single time. And for those who are listening back at home, if you guys enjoy these kinds of things, definitely check out Robert on X. Give him a follow. He's tagged right above our faces on X. If you're watching on YouTube, go to the description. You can find him. You should definitely find him on YouTube as well. If you enjoy this kind of content, he puts a lot of it out there. Definitely recommend you guys follow him. Also, big shout out to Public. You guys probably saw a couple times. Robert pulled up some Public charts. And actually, Robert, maybe if you are able to pull up that tab that you had previously with the one of the Public charts, they are a legendary company. Big shout out to them for sponsoring today's show. We do have a paid relationship with them as our headline brokerage sponsor of the stream. They're an investing platform for those who take it seriously. By the way, whether you're a passive or active investor, you can use AI in a wide range of asset classes, from stocks and bonds to crypto to options, a lot of things we talked about today, to build a portfolio for the long haul. So if you want to check it out, you can find a link in the description or in the tweet below the stream. As always, investing involves risks, and this is not investing advice. And so, man, but big shout outs to Public for sponsoring the show. Big shout out to Robert for coming through and supplying the alpha as always. And if you guys want to keep the conversation going, head over to X on Spaces. We're going to be on the tokenization space here, and we'll be talking with the traders here in about an hour. So we got a lot of content coming at you. See you guys all in the next one. Take care, everybody. And we'll see you hopefully in a couple seconds on the space.